backdrop leading to this year's budget is quite different from what we've seen in prior years. The backdrop is certainly a lot more positive. We just compare to last year this time. From a global perspective, the main concern at the time was around tariffs, the impact that they would have on global trade and markets. Locally, the concern was around GNU stability. This time around, though, a lot of those global concerns have mostly abated. In fact, there's decidedly a more positive sentiment at the moment around the outlook of emerging market assets. That's bonds, currencies, equities. And locally, notwithstanding the fact that we have local government elections later in the year, there certainly seems to be some stability in the GNU. Outside of these factors, one of the main themes coming through in this year's budget was certainly around the strong commodity prices that we've seen over the last year. And that's certainly particularly the case within precious metals, your gold and your platinum. This strength in precious metals has had a significant impact across South African asset classes. And we certainly saw the effect of that coming through strongly in the budget. The higher commodity prices meant that corporate income tax, net VAT were much higher than what was anticipated. We saw an overrun of just over 20 billion. Now, those overruns were allocated to debt repayments, some expenditure items, but it also meant that the previously muted tax hikes of about 20 billion rand or so were not implemented. Now, in the budget, Treasury also adjusted some income tax brackets for inflation, which is something that we haven't seen for a couple of years. There were increases in medical tax credits, and importantly, from an investment perspective, there was an increase to the annual tax-free investment limits by about 10,000. There was an increase to the limit of fund deductions for retirement. Single offshore allowance was also increased. Basically, what this all means is that consumers have more money left in their pockets and a greater incentive to invest. And then just more specifically related to how one should think about this budget from an investment portfolio and markets perspective, it's just worth remembering that notwithstanding our diverse and very much advanced capital markets, a lot of global investors still view our local assets as a commodity play, which is to say that when commodities do well, when there are strong commodity prices, particularly in precious metals, we tend to do well. That certainly was the case last year. I think the key going forward is whether this commodity windfall that Treasury has received will filter through to the rest of the economy. Now, we think early indications from this budget suggest that's certainly the case. Reduced government borrowing means that the cost to service debt decreases, which means that government can allocate more of that money towards infrastructure investments, which supports faster economic growth. As that happens, this encourages private companies to invest more in the economy, and then increased investment capital or increased capital investment, which has been a drag on growth for a while. Ultimately, this improves employment and consumption. So what we really need to see is this trajectory that we're on continuing to move in that direction. So bringing it all together, we believe that the re-rating that we've seen in some of our local equity market and that we've seen in our bonds, we expect, particularly what we've seen in the equity market, the rally to spill over into more consumer-focused parts of the market. Reduced borrowing is supportive for the bond market, which in turn justifies the currency strength that we've been seeing over the last year or so. The key is to utilize this commodity windfall by strong execution so that it filters through to the rest of the economy and into the broader market.